Okay, let's get started. This is the CASO presentation, the Computer Animation Studios of Ontario, presentation on financing opportunities for the animation and VFX sectors of the entertainment industry. And I'm your host and moderator today. My name is Mark Edwards, and I'm the founder and managing partner of an entertainment law firm called Edwards Creative Law. We have an office in Ottawa and Toronto and now Winnipeg, and our practice is national in scope, excluding Quebec. And I'm thrilled to be joined today by Andrew Giosa, who is the Vice President and Team Leader for RBC of their media and entertainment practice based in Toronto. And as many of you know, RBC is and has been for a couple of years now a member of CASO, and we're thrilled to have Andrew join us today. I also am joined by Mark Michalika, who's a commercial account manager mid-market. Maybe we'll get Andrew or Mark to explain what that means, being the manager of mid-market. But he's with BDC's Toronto office, and his focus is on flexible financing and advisory for a diverse portfolio of clients that includes the animation, VFX, and entertainment spaces. So Mark, welcome to the panel. And finally, we have Rob Luini of EDC, and he is the Ontario Sector Lead and Commercial Account Director within Export Development Canada's Technology and Media Industry team. Rob, welcome. Thank you all for joining us today. And thank you for the attendees of today's seminar. Most of you, if not all of you, are members of CASO, and this is a seminar among many that we have been pleased to bring to our membership to deliver what we hope is valuable information and insights in the management, operation, and growth of your animation and VFX businesses. So without any further ado, I would ask our moderator, Anne Denham, to put up the first slide. And Andrew, would you please kick it off for us, please?
Absolutely. And thanks for the warm introduction, Mark. Hello to everyone, and thank you for joining today. So I'll start off first, and if you can go to the next slide there, with something that Mark mentioned, and that's that RBC is, I'm representing RBC, but we are a proud CASO member. As Mark mentioned, I lead the team, the media and entertainment team that is based in Toronto. We're a team of 10 relationship managers that are focused on the media and entertainment industry, and that includes everything from film production, music, digital media, animation, visual effects, live entertainment, and sports. And we're 19 across the country. So RBC is both Canada's leading commercial bank, but also the largest bank that is dedicated to the media and entertainment sector. In the panel today, I will be, you can think of me as both representing RBC, but also representing a senior commercial lender or a Canadian chartered bank. So if you're not dealing directly with RBC, you can kind of take the position here and transplant it to who your primary bank is. But of course, obviously happy to chat with anyone if they're not getting the advice or support that they're receiving from their existing bank. I'll just mention one more thing here, and that really is the depth and breadth of experience that RBC has had in the media and entertainment vertical. We have over 3 decades of dedicated experience. It really started with going into interim production financing for film and television, and has expanded to other areas. We're completely vertically specialized both on the relationship management and credit adjudication side of things. And we've complemented our strength in Canada with the acquisition of City National Bank that is based in Los Angeles in 2014. And through City National Bank, we've actually acquired 3 different fintech companies that are dedicated to the film and entertainment vertical, which includes Film Track that might be of interest for a few folks on the call today, in terms of tracking residual rights for projects that they might be working on. So that's it for for RBC specific things. If you want to go ahead here, let me spend a little bit of time. As you heard from what Mark had mentioned, there's a couple of panelists here. You've got RBC, EDC, BDC. We're going to spend a little bit of time today talking about, what is the unique role that each party plays? How do we kind of fit together? And kind of the starting point is to really think about who's providing capital in the business. And I can see in the participants today, we've got some very well-established studios. We have some more emerging studios that are joining the call here today. So, if you're not familiar with various sources of capital, the best way to think of it is if you started your own business and you're just emerging, you are the sole provider of capital, or your investor group or your partners have provided capital. And then you would have additional parties that could provide debt and equity that really fund your business. That first step in terms of working with a lender, and in the context of the Canadian banking industry, is that Canadian banks, commercial banks, really operate as senior secured lenders. So what does that mean? It's pretty straightforward. It's essentially that to qualify for commercial credit, a bank would look to have a registration against your company in a first position. So essentially, a bank or a lender would look for two strengths to lend money out, and that would essentially be cash flows for repayment and collateral security. So a commercial bank operates as a senior secured lender, and a first claim on the company's cash flows and other real assets that the company has. One of the things that I want to mention is that if you're not familiar with it, a senior secured lender, or any registration that a lender would have under the PPSA Act, would also include a charge on intellectual property. The difference being is that a lender would not typically have any interest in commercial participation in your projects. It would the security interest would be limited to the amount of funds that would be extended to the borrower. So as you can see here, I think this is a great graph, and it really sets up the discussion later today on how the various parties kind of stack together. So the best way to think of it is a bank operates really at the lowest end, or the lowest side of the risk curve. So the bank has the highest qualifying criteria in terms of risk mitigants, in terms of the value of a collateral security charge, in terms of having a strong operating history, demonstrating cash flows. But the offset to that is the bank will actually be your cheapest source of capital. If you're looking on the left side of this graph here, debt is a cheaper source of capital. Essentially, the bank charges their prime rate plus 1%, 2%, 3% interest. And you can kind of think of equity as you move towards equity, the equivalent interest rate would probably be like 16%. If you're looking at something like convertible debt or private equity, we'll kind of put those terms to the side for the time being. But I think this is a good visualization of how the various parties work together here. And if we go to the next slide, again, I think that this is really useful in understanding how some of the other panelists kind of fit into the equation here. So if the bank is the cheapest source of capital, you may think, well, let's just load it up and look to our banker to provide all sources of capital. And I think, that makes sense in terms of kind of tapping out the cheapest available capital as quickly as possible. But there are certain circumstances where either there isn't an ability to meet the requirements that a senior lender would have, or the growth that you're experiencing in your business requires some additional leverage. And that may be beyond what the scope of your senior secured lender, whether that's RBC or someone else, can provide. So if we look here in kind of the dotted line, you can see the bank with the asterisk there, enhanced, really represents credit enhancements or co-lending opportunities for a senior secured lender, and perhaps an organization such as EDC or BDC. And you know, guarantees or credit enhancements really do mitigate the risks for senior secured lenders and allow us to kind of move up the curve in order to structure debt in a more advantageous way. So I think we can move ahead to the next slide. And
perfect. Thank you, Andrew. That's a great backdrop for the discussion today. As you know, I mentioned in a previous call with you, I think that's a really helpful graph, and one that both Rob and Mark will refer to. As you say, you know, as you move up the risk curve, the products that Rob and Mark, their organizations, offer can allow the bank to participate in combination with either BDC or EDC or both. And although there's a slight increase in cost, there is this risk sharing that overall gives the borrower the opportunity to take advantage of credit that would not otherwise be available at the lowest cost for a small incremental increase in cost. So it's always that balance of the cost of the capital and the risk, and understanding how each of your organizations play in along that curve, and how by working together you can develop what you've called, Andrew, enhanced products that find a different spot on that curve. So with that in mind, Mark, tell us a little bit about BDC and where it fits in that context.
Perfect. No, thank you, Mark. And Andrew, I appreciate you doing most of the heavy lifting, so it makes my job a little bit easier to give the details where BDC fits in. So again, I'm Mark McLicka. I work out of the downtown office at BDC in the mid-market segment. And for anyone who doesn't know, BDC, you know, at its core is a development bank and a crown corporation, wholly owned by the Canadian government, but operating independently. And you know, as Andrew pointed out as well, we really do work as a complementary facet to the financing world, in conjunction with your day-to-day private sector financial institution. And really what our goal is to fill the gaps kind of needed to continually grow your businesses at every stage that they're at, whether it's early stage, expansion, mature. And we've been doing it for about over 75 years now. We started with small and medium, and now we do companies from pre-revenue all the way up to, you know, public companies, through financing and advising, like I said, in conjunction with your primary institution. And just in the next slide there, I'll kind of go over, you know, a little bit more of the specifics where I think this would be beneficial to this industry in general. So whether you're early stage or expansion or mature, where BDC really does fit in is we have a couple different solutions to kind of help continually grow the business, you know, domestically and abroad. And those are through term debt, growth capital, and advisory. So when we think of term debt, for example, this is, you know, these are cash injections that we help get into the business that you may not be at a stage yet that you could get from your chartered institution, or again, maybe you've capped out at that cheaper option, and we want to help create a solution that's a little bit more flexible, that kind of works for both parties and really takes the banking experience to an enhanced stage. And so for term debt, it could be cash injections for you know, expanding your market domestically or abroad, launching marketing campaigns, investing in technology, or developing, you know, products or R&D that there may not be tangible assets for your primary bank to actually use as security. And you know, if we can, you know, get you from A to B, that it usually unlocks the next step of or suite of options that you have from your chartered financial institution. On the growth capital side, it's really for those high growth businesses or mature businesses where we don't want to dilute the ownership, and we don't want to go, if we go back to Andrew's graph, we don't want to go to those very expensive options and dilute some of the ownership, when really we just need a capital injection to get us from A to B and usually increase the value of our companies exponentially. And this is when we have, we don't have tangible assets that we can latch onto. And just as it mentions there at the bottom, these are very much solutions that we do, in conjunction with RBC. We've had a great relationship with, and I'm sure we'll talk about a few scenarios that we've worked on, a couple of really good co-lending deals for our clients. But a lot of times we'll be brought in either by our clients or by their chartered institution. And I'll get into a little bit more of the specifics, but anytime you need to take it to the next level and we're looking for extra capital that we're trying to squeeze out, that's generally where we fit in the curvature of the financing institutions.
Fantastic. Did you? Okay, perfect. Sorry, I thought you had one more slide left, Mark. Okay, so thank you for that. Rob, tell us a little bit about EDC, and just by way of primer, interesting that although EDC is not a lender, as RBC and BDC are, it nevertheless has a suite of products that that are very much complementary to what RBC and BDC do. And interesting, I've kind of followed and worked with EDC over many years. And when Rob walked us through the presentation a couple of days ago, I think both Andrew and I discovered that they had products we didn't know they had. And so I'm hoping that this will be helpful and informative for many of you to understand how EDC can be part of this picture. So Rob, please introduce EDC.
Perfect. Thank you so much, Mark. So we are BDC's sister crown, and it's my job as an export credit agency to help Canadian exporters go, grow, and exceed internationally. Now, the first thing is, what's an exporter? And it was always funny talking to some of my other clients, and I'm like, oh, are you exporting? And they're like, no, no, no. I'm like, okay, well, what are your sales to the States? Oh, about 50–60%. I'm like, okay, well, you're an exporter then. You have to, it's not just North America. It's like you have to think of it as selling anything outside of Canada, which brings me to my first one here, direct sales. Anytime you have a license agreement or a sale agreement with a company that's outside of Canada, it is a direct sale and an easy mark for us to say, yes, you are an exporter. Our products and services do work for you. But the next one's a little bit more convoluted, and where a lot of the creative industry space gets doesn't think of themselves as an exporter. But if you think about a project that is ultimately going to be either sold directly or then distributed long tail out to the market, if you're helping to complete that project as part of the supply chain, you're an indirect exporter in terms of helping other Canadian companies complete content that would then ultimately be exported. And then the last one is where you're going through and you think that you are going to be exporting. You've got an export plan, you've got potential contracts, and you need a little bit of extra support. We can go through and help with some of our products that I'll talk about here shortly, and allow you access to working capital to help complete those projects that will ultimately be sold. I think the key here is 90% of this industry is ultimately going to be somewhere on that list. It's always worthwhile picking up the phone, giving me a call, and sort of talking about what your long-term vision looks like of what you're trying to do and what you're trying to achieve. And let's figure out if there's a way for us to help and support you. Now, if we can go to the next slide, I'll talk a little bit more about the help. So as Andrew mentioned, there's that bank enhanced section, and that is us. We go through and we like to be partner preferred. Our job is to go through and really help Canadian companies get to that next level. It's usually that point where the banks really like what you guys are doing, who you are, who some of the contracts are, but there's still that little bit of risk. And I really want to help them shore up their security package so that I can graduate you to not needing us. The other aspect of this would be when there's just risk that the bank isn't comfortable with. Foreign jurisdictions is the big one. So if you were going through and you wanted to set up shop in the States or in the UK, and the bank was just saying, we can't get there, even with our guarantees, or we can't get there, our guarantees will come in and help them take away that international risk. The next stage is if it's really in a market that they're not comfortable with, we do have direct lending, but that's a little bit more on the upper end of the scales. Our guarantees are usually on the smaller end, and then we can look at a guarantee direct lend mix thereafter. But it would qualify for stuff like the provincial and federal tax credits. We can look at production and co-production financing. We're working quite closely with RBC on a couple of international co-productions to see if we can look at lending against the foreign tax credits. We can look at corporate operating lines. We can look at equipment. And then really our niche is kind of those foreign offices and helping you buy foreign companies. A lot of what I'm hearing about in the animation space right now is access to talent. And I've got a lot of clients that are telling me that one of the best ways to get access to talent is looking internationally, and can they buy a company that would then help them get access to additional cheaper talent that is just as good as the Canadian marketplace. The next sort of bucket is ensuring payments from international buyers. So we can go through and make sure that you're going to get paid up to 90% coverage. You can have the comfort of knowing that you've got a new client in the UK that you've never distributed to before, or there's a production services agreement that you've never worked with before, and you just want that little bit of extra comfort. Or maybe the bank is looking at it for margining purposes. We can add that back into your borrowing base and give you comfort that you're going to get paid up to 90%. Next, please. So the next is our guarantee on deposits. Think of security deposits. You're a renter and you have to put down your next 6 to 12 months rent, and you'd rather have that cash back into your operating general operatings. We'd be able to go through, and Andrew would be able to issue a letter of guarantee to your landlord or any of the guilds to be able to then have EDC backstop that 100% guarantee and get that cash back into your hands to be able to operate. That same program is also able to be done with foreign exchange risks. So if any of your providers are looking at a little bit of security in case the market shifts, we'd be able to give them a guarantee at 100% to allow you to set up contracts. I think the big thing with the foreign exchange is because some of these animation contracts are so long, it's making sure that you set up a proper strip of forwards or mitigation techniques so that a good contract doesn't go bad due to exchange fluctuations. And I will pass it back.
Perfect. Well, thank you very much. I appreciate that, Rob. And thank you all for that introduction to your suite of products relevant to these two industries, animation and VFX. So that's phase one, phase two, and we've got 12, just after 12:25. So what we'd like to do for the next 25 minutes or so, before we have a brief question period, is we want to walk through 3 stages of a company's development. So we're looking at early stage, expansion stage, and then mature stage. And what we'd like to show you is concrete examples of how these 3 institutions can work together. The chartered bank, the BDC, and EDC can work together to provide solutions that are appropriate at each stage of your development. So let's start off with the early stage, and Mark's going to lead this discussion from the BDC perspective. Go ahead, Mark.
Perfect. So just as some context, when we talk about early stage, what we really mean generally across all financial institutions are, companies that are pre-revenue, just starting out, or kind of 24 months in business with continual sales. That period can extend to up to 5 years, depending on your definition of startup and where you want to classify it. But where it's important to kind of think about financing early on in a business's journey is whether you are new grads starting a business, or you are experienced executives who are breaking off a piece of their existing business, or maybe starting a new venture entirely. There's different hurdles you're going to face, and the access to capital definitely has a bunch of its own. And where you want to work with your chartered institution or your day-to-day bank is, again, if we kind of revert back to that first slide and we talk about what your chartered bank needs, it's cash flow or history of cash flow, so that kind of recurring revenue that you make on a yearly basis, as well as security that you can pledge to kind of access that cheaper debt. Obviously, early on in a business, you probably don't have either one of those things, or limited in either case. So where BDC typically steps in that regard is if we have a solid business model, some good management, and previous industry experience, we can get behind a lot of companies that are taking on contracts but just don't have the cash flow to kind of access that debt. We can do, term debt where we can section it off and do cash flow injections for, hiring, especially for some of the animation, like there's some significant hardware investment you need up front. What we'll do is we will do that as term debt to kind of help you then graduate to your charter bank, because normally the upfront cost can be quite stringent, a couple hundreds of thousands of dollars. If you take the debt in the beginning, typically that will give your chartered bank assets and cash flow in years 2 and 3 and 4 of your business, that then you can slowly start to get access to that cheaper capital, and BDC can kind of be exited out for that stage of the business as well. So an example I would use is, one of my clients, one of my first clients actually in the animation space, 20 years of experience in the industry, was starting their own venture, and had the know-how, and as a financer, that gives you a lot of comfort, right? When you have someone with such experience. Had a solid business model, had contracts in place, had a relationship day to day with their chartered institution, but obviously didn't have the cash flow because they were pre-revenue. We were able to do an initial $250,000 injection to hire a few key developers and pay those wages for a 12 to 18 month period, as well as launch kind of that initial marketing push to acquire those new contracts. And at around that 24-month, 36-month mark, they were able to access the same amount of credit from their chartered financial institution. So those are kind of the hurdles you're going to see very early on. RBC has some really good solutions that we pair with them, like just past this stage after that kind of 24 months. But again, if you're starting a new venture, or even if you're breaking it off in an existing piece of business that can be perceived as riskier from your charter bank, we can typically step in and help you get past those first 12 to 24 months, and structure payments and those things accordingly, so that we want to match up your term debt with when you're going to hit your profitability and hit your revenue goals, so that we're not overloading you with payments right away either. And that's kind of where we'll step in. And I'll hand it off to Andrew on this next part, because once we get in the initial amount and revenue starts coming in and there's some assets on the balance sheet, that's where, again, you can go back to your charter institution and say, hey, what can I access now?
Great, thanks for that, Mark. And I think one thing is that I want to make clear is the session today is focused on financing opportunities, but I think as you can hear, there's lots of other services that we offer, and it's true at every stage. So at the early expansion and mature stage, but more so at the early stage, the biggest opportunity, the biggest value add that your financial institution should be providing really is on that advice piece, is to set you up for success. And as I was listening to Rob and Mark speak, I was thinking I should have included a slide, because I think the key words that should really trigger either reaching out to them directly or brokering an introduction through your relationship manager at your bank is kind of the 3 E's. So if you're early stage, if you're going through expansion, or you're looking for something extra, it's something beyond what your current financial institution can offer, because we really do work well together as a team, and we see as a success where if a company is kind of early stage and doesn't meet certain requirements, Mark and Rob really are the first on our kind of phone call list, phone a friend, to try and support our clients. So that's just a little bit of table setting and a bit of background. I do want to spend a bit of time going through an example here. So throughout these examples, I've kind of thrown out 2 different scenarios. I'll speak to one, but the rest of the information will sit on the slide here. So a quick example of an early stage company could be a visual effects company. It could also be an animation studio. Whether it is investing in capital expenditures for supporting a remote workforce, or a push into a new business where there's an acquisition of assets. So the example here is purchasing, LED walls or machine learning technology, motion capture hardware. Because of the nature of the financing itself, there's the purchase of hard physical assets, which as a lender really kind of perks up our ears, because as I spoke to before, there's kind of 2 things we look for. One is the value of collateral security and cash flows. So in many of these examples, if you're trying to get into the head or the thinking of any lender, you can kind of think of like your own home mortgage as an example. How do you get a mortgage? You've got a home, there's a valuation, you know what it's worth, and there's confirmation of income. So you can kind of use that as a frame of reference to think about how a bank or how a lender can kind of assess any request that you might have. And really here, I do want to kind of distinguish what the difference is for an early stage company versus a more mature company. So as I mentioned before, because of the quality of the assets, there may be an opportunity, depending on the assets, to do a standalone lease. So that may not include a first position general security agreement. So that's one of the first ways that we can get involved as a lender with a business. And again, it's dependent on the quality of the assets. Those would typically be standalone leases. And the complement on the more mature side of things is this concept of a revolving lease. So as your business grows and expands, you want to make sure that your staff has the most up-to-date equipment, that they're able to kind of push boundaries and deliver exceptional product for your customers. So something like a revolving lease line will actually allow you to kind of turn over that equipment in a really, really efficient way. Again, that's something that is kind of a step up once you kind of establish a good history of operations. And just to kind of pause here on the solution itself and some of the things that are unique is that many folks actually go out and they might acquire equipment on their own, and the pandemic was a great example of this, where people spent money quickly because they had to. But one of the things that I think was a learning lesson for many was that you can actually go back. Not every financial institution does this. RBC does do this. They can structure what's called a sale leaseback. So even if you've had a cash outlay of expenditures, you can make the purchase from multiple vendors, come back to your financial institution and say, hey, I bought a bunch of equipment. Can you put a lease line together? And essentially, you are now in a position where you don't have a massive outlay of cash and capital in one operating period. You can actually amortize that over 2 years, 3 years, whatever that useful life is of the asset, plus you have a tax advantage. So this is something that many folks do take advantage of. And again, I think gives a nice transition maybe into, from early to a more mature stage.
Interesting. Andrew, if I can just comment on that for a second. So essentially what you're saying is that the bank will become the owner. So is that right? Essentially you're selling your assets to the bank and leasing them back over a specific period of time.
That's exactly right. And you can structure it in a number of different ways. So you can have a $1 purchase option if you do want to own it at the end. There's options to kind of hand back the equipment and kind of revolve that lease. So it's a really interesting way. We've got a dedicated leasing group that has a full slew of options that are available. But again, the things to really hit on are, the advantages of a sale leaseback, the ability to deal with multiple vendors and kind of consolidate. Certain vendors might have quite high interest expenses. And the other piece there is, again, looking at more mature companies, there's actually an opportunity if you're doing leasehold improvements. I know people are, thinking about what return to office looks like. Some people might be giving up real estate. Some people might be taking advantage of, we need to reconfigure or, move into new space. There's actually an ability, if you're an established business or a mature business, where you can actually fold in leasehold improvements as well. So you could have one lease facility at an attractive rate that covers outlays for your capital as well as your leasehold improvements.
Okay, fantastic. Rob, Mark, anything to add before we move on to the next scenario?
I was just going to add, so our act precludes us from taking on lease, but if this was a true equipment purchase, we'd be able to guarantee the bank to take on that risk in a little bit of the earlier stage. And again, with all of the sales coming from that, we'd be able to look at insuring their foreign sales and domestic.
Fantastic.
Yeah, that's a good example, Rob. And I think what we would look at, I kind of hit the point of, it depends on the quality of the asset. So if it's an asset that the bank is not comfortable with, and we aren't able to structure either a lease or a term loan against it, first call again would be Rob and Mark.
Okay, fantastic. Let's move on to the expansion stage. Andrew, lead us off on this, would you?
Sure. There's, I had a hard time trying to narrow this down in terms of expansion stage rather. I know that many of CASO members are in the fortunate position of being stretched a little bit thin with growth opportunities. So many of you are currently in the expansion stage right now. One of the examples I put in here was something that we're seeing, and maybe we can focus on animation studios. An example here is interim production financing for a service deal. So that would be the animation studio completing a project where there are counterparty payments as well as production service tax credits and OCASE tax credits. So the challenge here is there may not be sufficient internal working capital within the business to bridge the timing delays between the expenditure and the outlay of cash to kind of create content and the ultimate repayment of those tax credits and counterparty payments. So the solution really is something that kind of grew up within live action, film and television, which is interim production financing. Can go into the details. I will say if there's any interest in the topic, we've actually held a lot of financial literacy sessions in this regard, and happy to go into a little bit more detail. There's no way to go into the detail today, but essentially wanted to shed some light on what that solution would be and what the qualifying criteria would be. So first and foremost, the qualifying criteria and the differentiator between early stage and expansion is to entertain financing of this nature. A real requirement is the track record. So has a company completed and delivered a project of that budget, of that size, of that characteristic have they completed it on time and on budget previously? That is the first question that will come up. So there may be an opportunity where, you know, there's self-financing, private financing, or alternative financing of a project, of the first project, let's call it, to kind of to start that track record. And then subsequent to that, the other characteristics are gaining comfort on the value of the tax credits, tax credit opinion letter, you know, preparation by an independent third party for validation, and an assessment as to the credit quality of who the counterparty payments are coming from. So, you know, ensuring that it's coming from a studio, it's not coming from an intermediary party, making sure that that we've provided an assessment on their ability to repay. I wanted to shed a bit of light on what an actual solution would look like. Some of the folks on the call may not have actually done interim production financing in the past. The way that this is really administered is through, at RBC, I should qualify, I know that some other financial institutions may have a different structure, really is two loans. So the first loan would be a principal loan facility, which is essentially a revolving loan. You can think of it like a line of credit. So you can have drawdowns, and then you can make you make repayments as those assigned receivables come in. So if there's counterparty receivables, they would be assigned and directed and be revolved against that principal facility. So you may be wondering, what's the other loan for? How do you access it? Essentially, this is something that's estimated, in this example, it's $250,000 of interest on a $4 million principal facility. It is the interest costs over the life of the project, and that interest is capitalized. So the unique thing here is there's no actual impact for to the operating cash flows in the business to service that loan. They all get capitalized. So as each month passes, interest on the first facility goes to the second facility, the interest reserve facility. And as cash goes in, once the principal facility is repaid, the sundry amounts get repaid on that interest reserve. In this example, the counterparty payment is coming from a large US studio. It could be a studio major, minor, or a streaming company. You know, kind of talked about the volatility in the marketplace right now. Foreign exchange, lots of volatility in commodities and stocks and in currency. As you're bidding on projects, the best way that piece of advice that I know my team and myself talk about often is making sure that you're locking in your margin. So not speculative foreign exchange trading, but making sure that you're locking in your margin when you're negotiating contracts with your customers. And a foreign exchange credit line allows you the ability to fix that rate out into the future. So you could win if the foreign exchange rate is favorable. You could lose if it moves the other way. One way to think about having a forward contract really is that you're essentially purchasing insurance. There's no outlay. You're just agreeing to a rate and acknowledging that it could be above or could be below. But again, best way to think of it is you're locking in the margin for your project.
Okay, Andrew, thank you. On that point, maybe I'll ask Rob to comment first on this, and just a note to the panelists, we're at about 12:45, so we're going to have to move relatively quickly through this and the later stage. I would like to leave some time for questions. So, but Rob, I see some opportunities there. Andrew's talked about the issue of foreign counterparty payments. Perhaps it's not a major or a minor U.S. studio for which the bank has a lot of credit information. Is there an opportunity for you there? Is there an opportunity for you in terms of some of the guarantees? Is there an opportunity for you on the foreign exchange side? So maybe you could address some of those issues.
Perfect. Yeah, no, I mean, this one looks great. I mean, where we really step up is, say the bank, you had done a couple of $10, $15 million projects, and the bank was comfortable with you knowing that you've been able to execute before. This is not outside of your daily WIC, it's just a little bit larger than what it normally would be. There was an opportunity for them to bring us in to help guarantee the interim financing, that $4 million principal loan down there, just so that they've got a little bit more comfort as you grow and expand into these larger shoes. The other aspect of it is you could have done a bunch of $25 million projects before, but maybe you do 2 or 3 a year, and now you want to start doing 5 or 6. So you've still got that expansion point, but you're taking on more projects and the bank might be a little bit hesitant. We can again come in and help guarantee those interim financings so that you're able to take on those projects. The other aspect again is that foreign exchange credit line. Typically, because of the nature of what it is and how it works, there's usually a little bit of security that needs to be posted in case you needed to unwind the contracts. And that's where we would step up and help guarantee the bank so that they didn't have to take any of that operating from that $4 million line or additional cash to post towards that, so that you've got access to those facilities and locking in your profits.
Perfect. Thank you, Rob. Mark, any comments before we move on to the mature stage?
Oh, you know what? Let's move on to the mature stage. I think my comments will kind of go nicely either or, so we can make sure we cover that off so you don't run out of time.
Okay, perfect. Thank you. Andrew, back to you.
Yeah, so I'll try and be considerate of time here. The mature stage, we talked about animation studios. We'll touch on VFX studios here, and I think that the sample here would be an experienced operator with long track record of working on portions of multiple feature films or television projects. The challenge obviously is timing of cash flows. May be hard to forecast and administratively burdensome to actually to do filing on individual projects. So an option for a mature company that we would be working with would be to kind of bundle together all of those tax credits across their entire portfolio of projects that they've worked on and actually lend against them in aggregate. So the way that we would go through this kind of mechanically would be establishment of specific facilities that are backed with a borrowing base or a margined amount against those tax credits themselves. So we would actually distinguish between the various types of tax credits. So you could end up with one facility that is margined strictly against OCASE, one facility that is margined strictly against the production service tax credit, the provincial portion, and we would just really be mindful of having those facilities lined up with the underlying assets themselves. And then some other considerations would be, just monitoring certificates of eligibility in the T2 corporate tax returns. Again, here in this instance, another company that would essentially look to benefit from hedging foreign exchange risk, especially since I think, as we all acknowledge, there are no boundaries. You can't be a successful animation or VFX studio, just within the neighborhood here. The content itself is being ordered and distributed everywhere else in the world.
Okay, thank you. Mark, perhaps you could comment on both the expansion and mature stage at this point.
Yeah, no, for sure. Because I think it goes well to both and kind of echo some of Andrew's comments. We fit in a lot of different places here, but really where to start, where you would think about us is for some of the expansion companies or companies that are mature that are looking to expand internationally or build out different portions of their business. Sometimes, like I said, if you're taking on already a large volume of contracts, you're looking to build out processes inside the business. Not just we can't get there to with your regular chartered institution, and you need to raise capital. What we'll do a lot of the times again is to not dilute and to not kind of go to outside sources. We'll come in and on the growth and transition capital side, we'll come in and do those kind of larger unsecured portions where there's limited assets to come into. So, for example, if we were looking to, let's say, expand into in the West Coast in the U.S. And we have an advisory practice where we'll actually go in identify partners, identify actually other institutions we could look at acquiring, and then provide that information back to your, let's say for RBC, we provide that information to RBC to help them make their own credit decision, and then fill in the gaps if we couldn't get there 100%. So if you ever, I guess the easiest way to say it is if you're ever finding in talks with your day-to-day financial institution, if we're not getting there to the full extent of the project you're taking on, never hesitate to include us, because there's probably a solution we can find. Having worked with Andrew's team, we're brought in all those conversations quite regularly to see if there's a solution. But if you're not dealt with RBC and you're finding you're just not getting there, there's usually, for these mature stage companies, there's a lot of different avenues we could look at before we look at diluting companies or giving away equity for no particular reason other than we just need the capital and there's only a small shortfall in getting there.
Fantastic. Thank you, Mark. I want to open it up to questions at this point. Please feel free to use the question button. I think it's at the bottom of your Zoom interface. Hopefully it is, and I have that open, so please do feel free to send me something. But in the meantime, until there are questions from some of the attendees, I want to touch on Mark's point about security. You've talked about assets. I think Andrew talked about hard assets, whether that's equipment, leaseholds, receivables, and you've talked about cash flow, but what we haven't talked about much is other kinds of security. And so, I'm most interested in, those early stage where the security isn't obvious. And maybe Mark, you can start that off, and the others can join in. To what extent are personal assets on the line among the founders or owners of the business, particularly in that early stage? And what other types of security do you look for?
No, for sure. Because I think a lot of times, like I said, we focus on those kind of larger companies that have physical assets that we can secure against. But, for us, what we typically look for in security, so for those early stage companies, there's not a lot. There's limited cash flow. There's potential IP depending on the industry. But for personal assets, for example, the way BDC views it is we do non-collateralized personal guarantees. So we don't typically try to take personal assets as collateral ever. We will use it more as a promissory note to make sure that we are repaid. But we try not to execute on actual personal assets because we don't like to interrupt the borrowing of an entrepreneur and their business. We try not to intermix them. And then slowly, again, you're usually priced into that. So again, as your assets grow, you'll normally get better pricing and more options from your chartered financial institution than you were in the beginning. But that doesn't mean there's not options for term debt at that stage either. What we'll also do earlier stage, like I said, if you're kind of in that pre-revenue to 5-year point, is we will take what's called a general security agreement against the business. Right. And that provides us some value outside of a physical asset, like a building or piece of equipment or IP. But for us, it's still an option to take it and provide you a little bit more leverage when we're looking at the amount of term debt that we can do. Okay,
fantastic. And Andrew, is that typical of the bank, personal guarantee and personal security? Mark, so they generally don't take.
I can speak to that because I think that's. I am off mute. I can speak to that because I think that's a key differentiator between working with a small business team and a commercial lender. So, the number one thing is this is a specialized industry. You shouldn't be dealing with a small business banking team. You should typically be dealing with a commercial account manager. The way things are typically structured at different financial institutions, like regardless of the financial institution, the key difference is with a small business, the strategy from the bank's perspective really is the owner is the operator is the business. They're one in the same and they're commingled. So the collateral security documentation for a small business is intertwined. You have the personal guarantee and the general security agreement against the bank, against the company in one document. They can't be removed. In commercial banking, it is different. They are standalone modular pieces. So the idea of having, without getting into the corporate, the legal aspects, a corporation has limited liability back to the owner or ownership team. However, if the company cannot stand on its own, that could be where the enhancement comes from. So the enhancement can be internal to the owners. It could be external by way of BDC or EDC. We would look to kind of build up whatever is required to get to the end solution. And Mark, I was going to say, I'm not sure if you can see this, but there's lots of great questions that are coming in.
I do see. So let me run to those quickly, and maybe I'll ask one of you to jump in. We'll try to get through 2 or 3. We'll keep responses to maybe 30 seconds or 45 seconds. The first is there a pre-approval process for financing? The context is an emerging VFX studio. And the comment is, rather than going through the ringer every time. So pre-approval to set up that relationship.
I can probably oh, sorry, Andrew. I was going to say, I could probably jump in there just because BDC is a project lender. Like, there's typically a process every time, but I will say, like, I think it's important to remember the process the first time you're doing any kind of financing with an institution, it's really starting the relationship, and whoever is doing the lending really has to understand who the management team is, what the business is, what the project is. And typically, as the relationship gets longer and more established, that process gets easier because, your relationship manager or your commercial account manager understands the business more and more in depth, and it's easier for that process to happen, right? So, you have to remember is every time you're looking to get financing, there's typically some differences to it. So there will have to be due diligence on every project that you're doing, but it does get significantly easier as you establish a relationship. And I'm sure anyone else here would echo that. And that's why it's important, as Andrew mentioned as well, like for people in the animation or VFX industry, it's very specialized. So, getting someone or getting on a specialized team like RBC's media and entertainment team is so important because it's much easier to have those conversations with people who deal in the industry than someone who's more general. Maybe that would be my answer.
Exactly. Yeah.
Sure. And the other thing that I would say is, as a senior lender, unless you have that long track record of being an established company, it's difficult to have an overarching facility, and that was kind of contemplated in the examples provided. I know that doesn't answer your question, so there is actually another avenue to go through, and that's to what Rob was saying before. Are you exporting, right? Like if you're doing VFX work as an emerging studio that doesn't have the track record, but you're able to bring in business, you're growing, that fits in the mandate of EDC. So not to say that it would be a perfect fit, but that could fit under something like the TELP program, the Trade Expansion Program, where the whole intention of that program is to simplify things for exporters to be eligible for credit. So that's something that we've seen. Doesn't work in every instance, but that's probably where my head would go first in answering your question. I'm going to take one other one real quick here because I can answer it pretty quickly. Who gets depreciation benefit in case of lease? Is it lessor or lessee? The depreciation benefit is that you can, without getting into the technical details, you can separate what your capital cost allowance is. So you can actually do accelerated depreciation and get a tax. So the tax benefit sits with the lessee. And you can do accelerated depreciation and actually get some capital cost allowance benefits when you're filing for your taxes. So I hope that answers 2 questions there.
Thank you. One more quick question that is of interest to me. There's a question. The question is an animation production company, in this case, a foreign animation production company setting up in Canada, entitled to financing by Canadian institutions. What kind of a track record do you need domestically, if any, to finance in Canada?
It depends. I know that that may
Good
be,
answer.
it may seem like a bit of
Lawyers.
a
That's a legal answer. I like that.
It depends. It depends on the jurisdiction. It depends on the tax credits. It depends on who's administering the tax credits. It
Okay.
depends how the entity is being set up. It depends on the ownership structure. Again, I think this is where the benefit of dealing with folks that have a lot of experience within the industry. Happy to take the question offline and speak in a little bit more detail around. But essentially, it really does depend. But having an advisor that can help guide you through what that process looks like is where the real value is, because it can get tricky, and you don't want to be in a situation where you map out a solution only to find out that when your tax credits are being administered, that the structure doesn't make sense, or there's withholding tax, and you actually have a hole in your project.
Thank you all. I think we could go on. We do have some great questions here. Please take note of the email addresses for Rob, Andrew, and Mark. They're happy to engage in a conversation with you offline, I'm sure. Would love to hear your questions about their products and services and how they might work with you. Thank you for joining us today for the CAISO presentation on financing opportunities. Thank you, Rob, Andrew, Mark, for joining us for the preparation of the, if I'm correct, Anne, the presentation will be available on the CAISO YouTube channel fairly shortly, so you're welcome to review it again at your leisure.
Yes, it will be available.
Fantastic. Thank you, Anne. Okay, I think that's it. Thank you all for joining us. Have a great weekend.
Awesome. It was a great panel.
Bye-bye.
Thanks for
everyone.
hosting, Mark.
Thanks,
Thanks everyone for some great questions.
Bye-bye now.
Take care.